everyone. Welcome back to Books and Backbone. I'm Donna Harris, CEO of Bookkeeping Made Simple, your host. And today is the last episode of July. We've covered a lot of ground this month. And by the way, if you're wondering why I didn't record last week, I was in Kentucky visiting my father, and I kind of judged that to be more important. And he has really awful internet. So that would be why. But we've covered a lot of ground this month. We talked about freedom, the cost of avoiding your books, the patterns I keep seeing in small business records, the business that couldn't be sold, the quarterly review you're not having, what a buyer actually pays for your business. And I want to close this month the way I think about this work by talking about what it actually means to build something that lasts. Not the motivation, not the hustle, the foundation. Because I've been doing this long enough to know that the businesses that last aren't the ones with the best luck or the biggest revenue. They're the ones built on something solid. And that solid thing, the thing underneath everything, is financial clarity. So let's talk about what that actually looks like. I want to start by clearing something up because I think most people have the wrong picture of what financial strength looks like. It doesn't look like a big bank balance. I know if that feels wrong, a big bank balance is pretty comforting. Money in the bank feels like strength, but I've sat across business owners with 6 figures in their account who are on the verge of collapse because they didn't know where it came from. They didn't know whether it would be there next month or what they actually owed. Cash can mask a deeply unprofitable business. For a while, it doesn't look like strong revenue. Revenue without margin is just expensive business activity. I've worked with businesses doing $2 billion a year who were less financially healthy than businesses doing $400,000 because the expenses were eating the revenue alive and nobody was looking. Revenue flowing in feels like success. It isn't success, so you know what's left after everything goes out. And it doesn't look like one good year. One strong year doesn't tell you whether the business is structurally sound. It does tell you something worked this year. That's useful information, but it's not the same as a foundation. Financial strength is structural. It's built over time, and it's specific. Here are 5 things I look for when I want to know if a business is actually strong, and I want to walk you through each one. First, the first marker I see is, do they have clean, reconciled books that are maintained consistently? At Bookkeeping Made Simple, sorry, I have a special guest in the studio today. We don't want to just have the books reconciled just before tax season or just because you have a buyer interested. Current every month and every week is better, reconciled with the bank statements, with no unexplained balances, nothing that looks weird, no deferred decisions sitting in a suspense account somewhere. This is the foundation. Everything else is built on it. When your books are current and reconciled, you have a financial picture you can actually trust. When they're not, you're operating on a best guess. And best guesses compound into expensive problems. I want to say something about this that I don't think gets said enough. Most business owners don't have clean current books. Not because they're negligent, but because no one explained that it mattered this much. They hand a box of receipts to their CPA every year for tax time, and they think that's the system. It's not. It's the end of a system. The beginning is the monthly work, the reconciliation, the current picture, and that's what makes the difference. Marker 2, a profit and loss statement that tells the truth, that really reflects reality. Revenue recorded correctly, expenses categorized accurately. Margins that reflect what the business actually earns after all costs, including the owner's real compensation. This sounds obvious, but it isn't. I've seen P&Ls that flattered the business because loans were recorded as revenue, because personal expenses were coded to business categories, because the owner wasn't paying themselves the market salary, so the profit looked high, but the business couldn't actually support a replacement for the owner. A P&L that flatters the business is worse than no P&L at all because now you're making decisions based on numbers that aren't real. Marker 3, a balance sheet that accounts for everything. Every asset, every liability, every obligation, no missing loans, no unreconciled credit card balances, no phantom receivables that will never be collected sitting in the asset column making the business look stronger than it is. The balance sheet is the place where things nobody wants to talk about show up, or should show up. The loan that was taken out casually, the partner distribution that wasn't recorded correctly, the credit card that's been running for 6 months without making it into the books. When a lender or a buyer looks at your financials, they look at the balance sheet. What they find there or don't find tells them whether they can trust everything else. Marker 4, cash flow visibility 90 days out. Knowing, not guessing, knowing what your cash position is going to look like 3 months from now. What months are historically slow? What fixed obligations are coming due? What the receivables pipeline looks like? What happens to cash if you add a new expense or lose a key client? Cash flow problems don't surprise businesses that are watching. They surprise businesses that aren't. And the watching, the 90-day horizon, the projection, the scenario planning, that's what separates a business that weathers a slow quarter from one that doesn't. Marker 5, a quarterly conversation that translates the numbers into decisions. This is the one that ties everything together. Clean books are only as valuable as the understanding they produce. Reports sitting in a file nobody opens aren't helping anyone. The financial picture is only useful if the person running the business understands what it's telling them. The quarterly review, and I've talked about that this month, is the conversation where someone sits down with you and says, here's what your numbers are telling you. Here's what it means. Here's what we should do about it for the next quarter. Not a PDF, not a file, a conversation. 4 times a year from someone who actually knows your business. That's the 5th marker. And it might be the most important one because without it, the other 4 data points sitting in a spreadsheet that nobody's looking at. When you have all 5 of these things, clear books, a truthful P&L, an honest balance sheet, cash flow visibility, and a quarterly conversation, here's what becomes possible. You can borrow capital when you need it because the financials support the application. You don't have to scramble or hope or ask a favor from a banker. You walk in with numbers that hold up. You can bring on a partner or an investor because the books can withstand scrutiny. There's nothing to hide and nothing to explain away. What you show them is what's real. You can make a hiring decision with confidence, knowing what the margins can actually support before you make the offer, not hoping it works out afterwards. You can weather a slow quarter without panic because you saw it coming 3 months ago and planned for it. And someday, if you want to, you can sell the business. No scramble to clean up years of records when a buyer is interested. Sell it. Add a number that reflects what you actually built. That last one matters to me. I've seen too many business owners spend years building something real and lose value at the moment of exit because the financial records wouldn't support what they were asking for. Exit prep isn't a project you do when you're ready to sell. It's the result of good bookkeeping done consistently over time. My family's been in America since the 1600s. We came as entrepreneurs, people who looked at an uncertain continent and decided the opportunity was worth the risk. 4 of my ancestors that I know of fought in the Revolutionary War. Before this country had a name, my family was building things here. What I've inherited from that history is a conviction that runs deep. You don't build something real by hoping it works out. You build it on a foundation strong enough to hold what you're putting on top of it. That's what this month has been about. Not the hustle, not the motivation, the foundation. Clean books, a profit and loss that tells the truth, a balance sheet that accounts for everything, cash flow visibility, and someone in your corner that explains what all of this means in plain English. It's not complicated. It's not expensive. It's just the work. Not very glamorous either. It's just the work done consistently, month after month, quarter after quarter. The businesses that last are built on that. The ones that don't last, almost always, had a financial records problem somewhere in the history. You're building something. Make sure the foundation is as strong as what you're putting on top of it. Thank you for spending July with me on Books and Backbone. We're coming back in August with a new theme, new guests, and more of the conversations that I think small business owners actually need to have, the honest ones, the ones no one else is having. If you've been listening this month and something landed, a story, a question, something that makes you think about your own books differently, I'd love to hear from you. Leave a review on Spotify, share the episode with a business owner who needs to hear it. If you're on YouTube, like, share, and subscribe, and hit the red notification bell so you get notified when new videos come up. And if you're ready to have a conversation about what your numbers are actually telling you, I'm here. The first call is free. You can find me at mysimplebookkeeping.com. I'm Donna Harris. This is Books and Backbone. Go build something that lasts.